Many investors with equity portfolios worry that investing outside their home countries will introduce exchange rate risks to their portfolios. It's absolutely true that currency fluctuations can affect returns over short-term periods, but it's equally true, at least in developed markets, that exchange rates tend to have a limited effect on equity portfolio returns over long time horizons. And we've yet to find good evidence that exchange rates can be predicted with any accuracy 20 plus years into the future. But let's take a moment to understand how fluctuating exchange rates can affect your portfolio's returns. So if you're based in Europe and allocating to the MSCI World, the benchmark for our global portfolios, you're introducing currency risk into the portfolio because about 70% of the index is weighted toward the US, and about 85% is ex-Europe overall. So in years where the euro depreciates against that basket of currencies, the value of the euro declines in terms of dollars. A European investor will actually see a return benefit because 70% of the stocks it holds are in dollars. Euro down, dollar up, non-European stock exposure helps. Years like 2018, 2019, and 2022 are good examples of when European investors in global portfolios were helped by a falling euro. Now obviously this cuts both ways, because in some years the euro can appreciate against the dollar, euro up, dollar down, non-European stock exposure hurts. Now I mentioned in the beginning that over long time horizons, exchange rates in developed markets tend to be relatively stable. When the euro began trading in international markets in 1998, the exchange rate to dollars was about $1.17. Today, as I'm speaking, we're at about $1.11. So the annualized return of the euro over that time period is negative 0.2% per year. That's just not meaningful enough to make or break anyone's retirement goals. That's because long-term, exchange rates tend to be anchored by a concept known as purchasing power parity, which posits that after adjusting for things like shipping costs, trade restrictions, and income levels, a constant basket of goods purchased in country A is likely to cost the same as that same basket purchased in country B once you've adjusted for that exchange rate. In the short term, expected changes in growth, inflation, and interest rates can all cause volatility in currencies. But long-term markets tend to adjust to keep things relatively consistent.